Hi, this is David. Welcome to a video review of Jorion's Chapter 17, which is called VaR and Risk Budgeting. And so this continues sort of in sequence from the previous Chapter 7 that was assigned. And you recall that was Portfolio VaR. And then here in Topic 8, the continuation skips all the way to Chapter 17, which has several learning objectives, and I'll say that one of the more important ones here is sort of tucked away in the middle, where we're asked to distinguish among the following types of risk: absolute risk, relative risk, policy mix risk, active management risk, funding risk, and sponsor risk. And these learning objectives really do need to be updated because we know that funding risk includes surplus at risk. So although it's not identified there, we know from long experience that surplus at risk is discussed in the reading within the subtopic of funding risk, and we want to pay attention to that. I'll show you the calculation for that later. And so that's the key learning objective, I would say. And then it has a supporting cast of, you can see, qualitative: describe, describe, describe. And this is a fairly aged, which is to say, old reading in the syllabus. So we start with define risk budgeting. And risk budgeting is the process of allocating and managing risk using a top-down approach to different aspects of the investment process. At the very end of this video, we'll see an illustration of that, and it will amount to taking an overall budget for value at risk, so a portfolio value at risk, or an aggregated, or a number of aggregated portfolios up to a business unit, for example. And risk budgeting will consist of cascading or allocating that overall VaR budget down to lower levels. And you will also recall that in general, we can think of VaR as a multiple or scaled of volatility. And so risk budgeting can be the scaling or allocation, really, either of the VaR or the volatility, because after all, the VaR is just a multiple of the volatility in our sort of general, simplistic, normal-based perspective. So this process is intended to systematically allocate return volatility, and so again we could substitute in here VaR quite validly, right? And I'll just note that just in case, so that I leave no doubt here. So as we know, we say VaR. We can sort of think of VaR as some deviate based on confidence as a multiple of sigma volatility, and so for that reason we can substitute in. The risk budgeting process builds on VaR measures that are applied to asset classes, asset managers, and even securities. Like value at risk, its main advantage is to provide a top-down, comprehensive, and practical method to manage risk. It provides a dynamic comparison of current risk profiles with pre-specified risk budgets. So this next learning objective asks us to describe the impact of horizon, turnover, and leverage on the risk management process in the investment management industry. And Jorion there distinguishes between sell side and buy side. So we think of sell side typically as banks or investment banks, and buy side would be, for example, private equity firms. So the characteristics here, or this basic distinction that Jorion makes, is that the sell side horizon would tend to be short term as opposed to a longer term horizon for buy side investors. When we think about a private equity or venture capital firm, typically those investors don't have an expectation for quarterly returns or annual returns. They may even be locked up. So they would tend to have multi-year horizons, maybe 4 to 7 years. Turnover in sell side consequently might be rapid, and in buy side it should be slower. Leverage in sell side might be high, and in the buy side typically might be lower. And then our risk measures here on the sell side are VaR and stress test, and on the buy side would tend to be asset allocation and tracking error. And so the risk controls then follow from the risk measures and would include, on the sell side, position limits, VaR limits, stop loss rules. On the buy side would be diversification, benchmarking, and investment guidelines.